Good afternoon, everyone. Thank you for joining us on this analyst and fund managers presentation to the proposed acquisition of TotalEnergies Brunei. I'm Lily Ling, VP of Corporate Development. Let me introduce the rest of the Hibiscus team with me today. Dr. Kenneth Pereira, our Managing Director.
Good afternoon, everyone.
CY, our CFO.
Good afternoon.
Stuart McMichael, VP of Ventures.
Hi, everyone.
Deepak Tucker, VP of Economics and Business Planning.
Hello, everyone.
Joyce Wasudewan, Head of Corporate Finance.
Hello.
And Andrew Fernandez, Zihan Hisham, and Adila Alias from my Corporate Development team.
Hi.
The briefing deck can also be found on the website and on this Zoom's chat. I will now hand over to Stuart to start off on the presentation.
Okay. Hi, everyone. Thank you. So I'd like to start with the description of the proposed transaction and then an overview of the operations. So yesterday, Hibiscus signed a share purchase agreement with TotalEnergies Holdings International. That's, if you look at the middle of the page, it's the third blue box. And from them, we'll acquire 100% of TotalEnergies EP Brunei, which is indicated as the red box in the middle of the page. TotalEnergies EP Brunei holds a 37.5% interest in Block B of the MLJ Field, and it's currently the operator. So the JV partners in the field are Shell Deepwater Borneo Limited and Brunei Energy Exploration. They're shown at the bottom of the page. And this is an operating, producing asset today. If you look over to the right-hand side of the page, this is the proposed transaction, is that Sempor Hibiscus will acquire what's shown in the dashed red line or dotted red line, TotalEnergies EP Brunei. So now I'll just mention a little bit about the Brunei oil and gas sector. Certainly, we're excited to be entering the Brunei energy industry. So Brunei is a politically stable Southeast Asian country with a gross domestic product of $27 billion. The oil and gas industry is the predominant industry, making up almost 90% of the Brunei exports. A key piece of that is the LNG exports that they have to the region. And last year, they produced almost 200,000 kBOED with a little bit heavy weighting on gas. If you look to the top right, the GDP last year was 1.4. The growth was 1.4%, and it's expected to be even higher, something in the 2.7 range this year. That's impacted by growth in the oil and gas industry, and they expect year-on-year growth, significant year-on-year growth next year. Through infill drilling and workover opportunities. Okay, I'll keep moving on. So the MLJ Field, if you look at the map to the left, the gray shaded outline, that is Block B, and then just in the middle you'll see a small red area. That's the MLJ Field. So a bit about the field. This was discovered in 1989, and it started production in 1999. The remaining reserves, so it's got 2P reserves of a bit over 24 billion barrels of oil equivalent, and 2C resource of almost 7 million BOEs. So the JV partners have long-term production rights until November of 29, but they also have a 10-year option to extend those rights. So it's about 15 years of additional production time period. So it's gas production. So 84% of it is gas, and then the remainder being the condensate. So I've got on the next page, we'll talk a little bit more about the facilities, but there's 3 unmanned platforms, and 22 wells have been drilled, 15 of which are still active. A very positive story is the safety and the environment. They've been operating for 24 years without a lost time injury, and the emissions are low, on the low side of industry average at 11 kilograms of CO2 per BOE. So with the acquisition, we'll take on the entire staff of the company as it exists today. So certainly it's an experienced, the high percentage of Bruneians, and with an in-depth knowledge of the MLJ field. Okay. A little bit more about the facilities. I'll direct you to the top right of the page. It's the 3 unmanned platforms that I mentioned on the previous page. They're connected by pipeline, an 85-kilometer pipeline to the shore. They tie into what we call the OPP, the onshore processing plant. So this is operated by TotalEnergies Brunei. So in this plant, they separate out the condensate and the water from the gas. And then the gas is sent next door to the BLNG. It's the Brunei LNG plant, where it's liquefied and sold to their customers. Then you'll see the other line, the condensate and the water, then goes over to Scott, which is the Soraya crude oil terminal. That's operated by Brunei Shell Petroleum. And from there, they strip out the water, separate the water and condensate, and then the condensate is sold from there. Okay, with that, I'll turn it over to Deepak.
Thank you, Stuart. Thank you, all of you, for joining this call. So Stuart has given us a good overview of the transaction. Now let's look at how much this transaction brings production reserves, and then the valuation by the independent valuer, RPS Energy. And then we are also going to talk about how we intend to fund this transaction, right? So this particular slide we have on top, we have production numbers from the Block B MLJ Field. And at the bottom, we have the reserves numbers, so 2P reserves numbers. So let's look at the production numbers. Primarily, it's a gas field, and it also comes with a little amount of condensate. So gas and condensate combined together is 7,800 barrels of oil equivalent per day. That is the production from this asset for 2024. This is the expected production for 2024. If you look at the actual production in 2023, it was 6,958 barrels of oil equivalent per day. And there's a slightly increase in production expected in 2024 because the Total and the team did some workover operation last year. And as a result, we see we are expecting some, and we are seeing some improvement in the production numbers. If you look at the breakdown of gas and condensate, you will find roughly about 85% of this production coming from gas and 14% or 15% is from. So that's a significant boost to our gas composition in our production portfolio, which Joyce will talk about. But if you look at the 7,865 barrels of oil equivalent per day that is expected for 2024, how much does it, its comparison to our current existing production numbers? So currently we are producing roughly about 21,000 barrels of oil equivalent per day. So it translates to roughly about 36-37% increase in our group's production numbers overall. Now let's look at the 2P reserves. So we are showing the reserves as at 1st January 2023 and also 1st January 2024. As you know, this deal is effective as at 1st January 2023. So the total reserves as at 1st January 2023, total 2P reserves is 24.2 million barrel of oil equivalent. But if we want to compare it against our current reserves numbers, so that is why we are showing you the reserves as at 1st January 2024, which is 21.7. And this drop is because of the subtraction of the actual production for 2023. Now let's compare the 21.7 million barrel of oil equivalent net reserves contribution from this particular transaction to Hibiscus Group. Currently, or Hibiscus Group before this transaction, 2P reserves is roughly about 61 million barrel of oil equivalent. So it translates roughly about 35-36% to our 2P reserves growth from this transaction. Okay, let's go to the next slide then. So this particular slide, we talk about the purchase consideration. So the total purchase consideration is $259.4 million, which comprising of the purchase price of $245 million for the asset, and then net working capital of $14.4 million as at 31st December 2022. So as you know, this is not an asset sale, it's a corporate transaction. So when we acquired the company, it comes with the net working capital, which is essentially current asset minus current liabilities. Basically, the cash and the receivables, and then we'll also have some payables. So net basis is $14.4 million. So this is the benefit which we are going to acquire from this corporate, and we are paying dollar to dollar basis. So on total basis, it's 259.4. At the time of completion, which we hope we would be able to close this transaction in 4 to 5 months, but hopefully we should be able to close in next 4 months. So at the time of completion, we will be paying $17 million of the interest or the time value of money on this transaction, on this purchase consideration, from the effective date, which is 1st January 2023 up to 14th of October 2024. That translates to roughly about 5% per annum of interest rate, would be $17 million. And we have already paid the deposits of $49 million US. So at the time of completion, we'll be paying 259.4 plus $17 million of interest minus $49 million of deposits. Right. That number would be close to 210, $220 million that we aim to fund from our internal funding, which we'll talk about later. Okay. Now let's look at the valuation. So we have had the competent valuation report and competent person report from RPS Energy. So they have looked at, they have verified and come up with the reserves and production forecast. Along with that, they have done valuation of the asset. So the valuation of asset for 2P reserves is a PV10, which is the 10% discount rate, is $236 million US. 2C resources valuation at 12% discount rate is $14 million US. So the fair market value of the asset is about $250 million US. And what we are paying is $245 million US for this asset. Okay. Now let's talk about the sources of funding. We talk about the net amount which we will have to pay at the time of completion would be 259.4 plus $17 million of the interest, and then minus the deposits which you have already paid, which is 49. That number is about $221 million. So we have to settle this $221 million at the time of completion. Given the fact that this deal is effective as of 1st January 2023, so all of the cash flows which asset has been generating since 1st January 2023 up to the completion will also belong to us. So it will help us to partly offset the purchase consideration, and the balance amount would be, we expect to be able to fund from our internal cash and the existing unutilized debt facilities. So what the key point here is, we are not going to issue any equity issuance to close this transaction. So it will be funded, fully funded. Its deal is fully funded from our internal cash and internal facilities. Okay, I think now Joyce will take us through these slides.
Yeah, clearly there are several key benefits to the proposed acquisition. Firstly, the asset is of considerable size, and as mentioned by Deepak, we expect it to significantly increase our 2P reserves, 2C resources, our daily production, as well as increase the composition of our gas portfolio. And it is in line with our growth strategy of acquiring producing assets in well-established, well-regulated oil and gas jurisdictions. And it's also in line with our energy transition strategy of increasing our gas portfolio. And as mentioned by Stuart, the asset has been long producing. It's been producing for the last 25 years and is clearly located in a prolific hydrocarbon-bearing area. And there are already identified plans in place to enhance reserves and to monetize resources and to increase production. And this asset will also capitalize on our core competencies of acquiring mature assets and then post-acquisition, putting in plans in place to increase production, not only arresting production declines, but also increasing production and reducing unit production costs. And we have successfully shown this in our last three acquisitions, which is Anasoria Cluster, North Sabah, and the Peninsula Hibiscus asset. And an important point to note is that we will be taking over the workforce. There are almost 100 full-time employees and contract staff that will come together with this asset. And they are highly experienced, strong track record. And as also done in our past deals, we will include some of our employees, some of our key people in key positions in the organization structure, so that the combined plan of having their employees together with our employees as well will provide continuity to the asset operations, as well as optimize the future value of the asset. And another important point to note is that this asset is underpinned by long-term contracts, which is the gas supply agreement with Brunei LNG. It expires in 2033. And there's also a condensate sale agreement with Total Energies Trading, a subsidiary of Total Energies. It expires in 2028 and it has a 1-year automatic extension. And this transaction will also allow us to establish strong relationships with an oil major, Shell, as well as the government of Brunei. They are also the joint venture partners in this asset. And all combined will solidify our position as a key independent E&P player in the region. This was alluded to by Deepak just now. If you look at the first chart, the ones in the columns in gray are our actual production rate for calendar year 2023, and then the ones in red is the inclusion of the MLJ Field. So if you look on the right-hand side, for daily oil production, it increases our daily oil production by 37%, by almost 8,000 barrels, from 21,000 barrels to 29,000 barrels. And then in the bottom chart is our 2P reserves. And this transaction will increase our 2P reserves by 21.7 million barrels, from 60.9 to 82.6. That's about a 36% increase. The increasing the gas composition of portfolio is actually one of our key pillars in our energy transition strategy. That as almost 85% actually of the production is gas. Our gas portfolio will increase significantly. In terms of production, it will go from 36% to 49%. That's a 13% increase. And in terms of 2P reserves, it increases from 18% to 35%, and that's a 17% increase.
Okay, thanks again for joining. Well, what does all this mean from an earnings perspective? Now, hope these numbers will bring a little bit of insight as to what we hope to report going forward. Now, the chart on the left-hand side have two very important numbers. The one on the far left with in red was the PAT that Hibiscus Group reported in the previous financial year up to June 2023. There was about 400 million ringgit Malaysia. Based on the information that we have provided and reviewed for the Total company that holds this asset, up to December 2023, so the 12 months up to December 2023, the PAT reported was equivalent to ringgit Malaysia 150 million. So that's, you can see that it is a fairly sizable addition to what Hibiscus Petroleum is already currently reporting. Okay, and if I were to translate that to the earnings per share metric, as at 30th June 20, or up to, or for the year, financial year 30th June 2023, reported 50 cents at that time. Now, if you compare to the incremental earnings that we should hope to report, or close to this number, that would mean that it is about 36% increase in EPS, close to 70 cents. So that's really from a financial impact, how we would expect this asset to contribute to our group earnings and earnings per share.
Okay, good afternoon, everyone. Let me just kind of close off the presentation with a few key messages. I think the important thing that we have been stressing over a period of more than 2 years maybe we've been saying that our intention or our mission was to double our production from about 20,000 barrels of oil equivalent a day to something in the range of 35 to 50,000 barrels of oil equivalent per day. That's been our target. And I think what you will see from this transaction is that 2 years, we're almost 2 years ahead of target. We're going to probably get to somewhere between 31 and 35,000 barrels a day, somewhere between 2025 and 2026. So well on track towards achieving our disclosed targets. And it's been not an easy task. It's not easy at this high oil price to find good assets, but we think we've found something really good. When we look at this asset and we look, we kind of think about all the criteria we have when we try to find or we try to select an asset that we should focus on. We've been looking for a gas asset, and this is a gas asset. We want it in a region that is stable, or in a country that is stable, got a proper legal system that we understand. Brunei fits that as well. It's a stable country. It's a country where oil and gas is really important to the economy. I think 90% of Brunei's economy is around the oil and gas industry. So it's something that they prioritize in their policies. So it's somewhere where we think we can work with a certain amount of stability. We had to find an asset that was material, but also at the right price in this oil price or in this oil price environment. So I think we think we've achieved that with this. It had to be it had to be affordable to us. We always look for strong partners in an asset. Here we have the government of Brunei and Shell. I mean, this is exactly the type of profile of companies we'd like to be working with. We look for operatorship. We found operatorship here. We wanted to get some of the people to come across with the company. Here we're getting, between 70 and 100 people who have long experience in this looking after this asset. And one thing that really comforted us, it's an asset that has had a long track record, a very good, excellent safety track record. I touch wood, but a quarter of a century with no major incident. That tells us that there's a strong safety culture and strong pride in the asset. That tells us something about the type of people we are taking on board, and that gives us a lot of comfort as well. 35,000 barrels a day, that's barrels of oil equivalent a day by 2026. That's going to give us a reasonable level of scale, and those are net barrels. As a gross production number, we'll be looking at almost, I think, about 100,000 baht. We'll be operating assets delivering about 100,000 barrels of oil equivalent per day to various partners and governments. So that's a large operation. Okay, so it's a competent workforce that's coming across, long-term contracts with BLNG, very strong offtake arrangement for the condensate with Total, being the condensate, will be buying the condensate, the liquids. So all of those give us a really good feeling about this asset. Ticks many boxes for us. So this is the reason why we have looked at this asset and also the opportunity around it. And probably your questions we can answer. We can give you more color about this when we talk about the asset more. And as you can see from a 2P reserves point of view, we'll be going from 61 million barrels to something like 82 million barrels now after the proposed acquisition is completed. And then again, moving us towards our 2026 target of trying to get it to 100 million barrels of oil equivalent in 2P reserves. So very much an asset that puts us on track, and something very close to the infrastructure we already have in the area. One of the things we didn't mention too much about, but if you look at the map, which Stuart spoke around earlier on, there is a common oil field across the Malaysian and Bruneian borders. So that maritime border has got a common oil field. So we will be, I think it's helpful that know both sides, the geology, both sides of the border, actually, because on the other side of the border is actually the Kinabalu area, actually, where we also have a PSC. So we know that part of, we know that address, that geography pretty well, and that geology pretty well. Okay, so I think the next slide is the last slide. But I think what this slide is trying to say is we're slowly building a footprint in the Southeast Asia area. I think we are, has someone told us, one of our business partners told us yesterday, we're becoming the go-to company. If you have an asset in Southeast Asia and you want to do something, chances are our name are pretty, we're in the top 2 or 3 companies you come and talk to if you want to speak with an independent. So really very proud that we've been able to do a deal with Total. So in our last 5 or 6 years, maybe 10 years, we've dealt with Exxon, we've done with Shell, we've dealt with Repsol, and now we've done with Total, all large companies. And it gives us a lot of credibility so when we want to do deals in the future. So I think that would be where we would end the presentation. So I think I'll hand back to Lily and take questions.
If you have any questions, feel free to raise your hand and you can unmute yourself, or you can also put it in the chat box. We ask the first question. It's from Alvin, Philip Capital. Hi everyone, what's the book value of the Brunei asset? Book value.
We would have it in our announcement. Announcement it will be.
Well, we get it for you, Alvin. Cliff has a message. Ken, congratulations with the new asset. Is roughly 50% gas composition something you're comfortable in longer term going forward, and why?
It's a nice place to be. It was somewhere where we wanted to be, but it's not something we don't have a policy about it. It's a nice place to be, and it definitely shows that we are making some effort towards our transition strategy. So I think nice place to be, but no hard and fast rule about this.
Let's go back to the question.
Yes.
It's in our announcement, page 22. The net assets of the company, the target company, in terms of ringgit, is almost 730 million ringgit. It's about $159 million.
Okay, I hope to answer your question, Alvin. Sinkat asked, when you mentioned existing debt facilities to be drawn down to fund acquisition, which of the existing debt facilities are you referring to?
We have some drawn prepayment facility from the off-takers. We have some capital facility. So combination of that, and we have the strong balance sheet, which you have balance at the Hibiscus group. So we'll use combination of it to close the transaction. Just to add, we might go to the market once we close the transaction. We might go to the market, raise some small debt on the back of these asset cash flow. We will do post completion of the transaction.
Okay. We go to the ones that raise their hands. With Malaysia, you want to unmute yourself.
Hi, good afternoon. Congratulations to the team. Actually, John Ho here from VUCA Insights. I forgot to log out the StockBit account.
Oh, okay. Hi, John.
Sorry.
Okay.
Congratulations to the team. Very well done. Just two questions from me. Probably the first one would be, I do know you may not have a very precise figure, but what would be an estimated abandonment cost for the asset at the end of field life? Second question would be, I'm trying to latch on to what Dr. Kenneth and Stuart said about, an exciting field, and it's a prolific field. So is there some sort of a preliminary capex, either for some exploration activities? And last but not least, is there any debottlenecking needed for, these 3 wellheads? Thank you.
Let me start with the decommissioning cost. So as you know, it's in the shallow water. It's an unmanned platform, 3 unmanned platforms, and we have active close to 15 wells, and then pipeline. So we have estimated the gross decommissioning cost roughly about $180–190 million, and our working interest decommissioning cost would be small, close to 70, in that range, $70 million. So this $70 million would be incurred in 2040, as you have seen that we expect. So this asset has been producing since 1999, so for last 25 years, and then we expect to produce for another 15 years up to 2039. So this $70 million odd would be incurred, our share would be incurred in 2040. The second question was?
The CapEx.
CapEx and any drilling CapEx or exploration CapEx.
So there's no exploration drilling CapEx, but we have seen the 2C resources, the contingent resources of 6.8 million barrel of oil equivalent net to Hibiscus. So to convert that 2C resources to the 2P reserves, what we have in place is we will be drilling one infill well sometime in 2028, 2029, and then we would also be doing one one major workover operations. So that will convert these 2C resources to reserves in next 3 to 4 years.
Yeah, last question. Right now, I think with the off-taker in place, I'm guessing, and do correct my assumption if it's wrong, there's no need for a debottlenecking on any of the facilities.
Yes, that would be correct. There is no need for any debottlenecking. Of course, when we acquire the transaction, once we complete the transaction, we will be closely looking at the if there are any ways to improve the capacity of the the entire facilities to further increase our production numbers. But based on the information which we have seen, we don't see any debottlenecking.
All right. Thank you so much, Deepak team. That's all for me.
Thank you, John.
In fact, maybe we could add something about the compression project.
Yeah. So I think I missed that one. So it's a gas project. Normally, after a few years, when the reservoir pressure reduces, there is companies who do the gas compressor project, which is to reduce the pressure at the facilities so that more gas would be flowing from the same reservoir. So the Total and the team are already pursuing this opportunity. So they are already in the midst of executing the gas compressor project, and we expect this to be completed by Q3 2025. So this capex has already been included in the valuation. So it's already part of the 2P reserves.
Okay. Yeah, I think we'll move on to Ho Meng from UOB Asset Management. I see you raise your hand. Could you just unmute him?
HMT.
Yeah.
Hi, good afternoon. Can you hear me?
Yes.
Hi, yeah. Thanks for the briefing. Just to follow up on the earlier question on the debottlenecking. So I understand there's no need from your side, but I've read that the Brunei LNG plant is probably even older than the Malaysia plant, and they did have some production issues in the past. And secondly, the gas sales agreement. I don't know what's the situation now, but the last expiry was all in last year. And the LNG ships were very old, and I think progressively they have been selling away the ships. So just want to know whether I don't know the site, whether they have renewed the agreements and so forth. But in case if you can't channel your gas to the Brunei LNG, do you have alternative markets that you can easily maintain your LNG sales? Your gas sales, sorry.
Okay. Can we go to that processing, the slide where we talk about all of the facilities, that it would be easier. So it's slide 3. I can share it. So we have gas being produced from the 15 active wells through these 3 unmanned platforms, and the gas come to OPP, which is onshore processing plant, where the basic separation is being done. So which means the gas is separated into gas and condensate and water. And then it is sent to SCOT. The condensate and water is sent to SCOT, which is the Syria crude oil terminal. And then the gas is sent to BLNG. We don't own BLNG. It's the Brunei LNG Sindrian Berhad. What we have seen is, in terms of the uptime for the facilities for last few years, it's really been more than 95-96%, if I remember those numbers. So from the unplanned downtime issue, we don't see that an issue from this particular project. And then coming back to the gas sales agreement, yes, we have the gas sales agreement up to 2033. And if you look at currently how much gas Brunei is producing, we looked at that slide. Brunei is producing roughly about 100,000 barrel of oil equivalent gas, right? That's the total production from the Brunei. And this particular asset, Block B MLJ is producing roughly about close to 20,000 barrels of oil equivalent, right? So 20% of the country's gas production is coming from this particular asset. So we think, that it would be expected that, that the gas sales agreement would be extended beyond 2033. And based on our discussion with the Total, we believe this would be like easy task to extend the gas sales agreement, given the fact that, this LNG plant, and then especially in the Asia, there's a lot of demand for the LNG going forward as well.
Okay, so if I understand correctly, if I convert to million tons per annum, they were roughly 5 million tons per annum. They were all renewed from by another 10 years, is it, to 2033? Something like that. Yeah.
Yes, so currently our gas sales agreement goes up to 2033. Yeah, that's correct.
And let's say because for those of us who cover Sapura Energy, they did have quarters where when the MLJ plant had some issues, it also affected their sales, So I'm just concerned whether your sales is dependent on the sales of your gas depends on the uptime of Brunei LNG, Yeah.
Yeah, that would be correct. But there is in the gas sales agreement, there would be take or pay. So in the event if we are able to sell, and if they don't take it, then there would be some mechanism by which they will, kind of compensate us. So last few years of data we have seen, and it shows that whatever we produced, we sold to them, and then there was not such an issue. But in the future, if that's an issue, it's being covered through the gas sales agreement commercial, the clause on the tax.
Okay, so got it. I have 2 more questions. What is the break-even cost per barrel of your site? I mean, also including the any cost that's related to sending over to the old Brunei Energy Terminal, and also in terms of your carbon emissions, what you mentioned there, that 11 kilo, it seems to be lower than Total Energy's current portfolio. So why would they want to sell?
Okay, let's hold on to the thoughts on the why they want to sell. But let's look at the break-even price. If you look at this particular in the Brunei, the fiscal regime is very attractive, and it's more attractive compared to Malaysia. So it's a tax royalty system. There is no cost recovery or profit all share mechanism. So there is a royalty of about 8%. That's a royalty, and then 55% of the income tax, petroleum income tax on the operations. So effectively, it's a very, it's very attractive fiscal regime. From revenue to EBITDA, there will be 2 components, which is going to be the royalty, which is 8% of the revenue to us, and then the OPEX numbers, so operating cost. Currently, for next 2 to 3 years, and for 2023, what we have seen is the OPEX per BOE would be close to $5 to $6 per BOE. And then you apply the royalty, that would be like, that would make, these 2 components will make the EBITDA break even. I hope that answers your question. I mean, depending on the gas price which you assume.
And then
Why would
I think we can only read what Total have announced, which is from time to time they do a strategic review and they manage their portfolio, and maybe this is not an asset that is material to them. That's about all we can say. In terms of the GHG emissions, yes, it is a good one for us to take on, and while it's lower than their average, I don't think that is the only thing that drives their divestment decisions.
Okay. Thanks, Ho-Ming. I hope that answered your question. If you have any more questions, just join back the queue later. We noticed there's a lot of people that had also questions. So we move on to Leonid Mironov. Said, congrats on the deal. Quick question, any further color on pricing on the gas supply contract and the condensate? Also, do you have an understanding if Shell is planning to stay in the project for the long term?
Okay, let's look at the gas and condensate pricing. So as Joyce mentioned, we have the offtake and the contract whereby the Total Energy, their trading team is lifting the condensate, and what we get is the spot price. The condensate is sold at slight premium to Brent, roughly about $1 to $2 per barrel. So if the Brent price is $80 per barrel, we get close to $81, $82 per barrel. That's the realized price for the condensate. And we have this agreement with Total Energy, and it will, and then we would like to continue with them. So this offtake commercial agreement contract is not an issue. Coming to the gas price, so what we have the gas sales agreement, and then the gas price, what we get is a function of the price which BLNG gets when they sell the LNG to the end customers, right? So it's a function of that. So currently in our 2023, you would have seen the price which in our cash flows. So 2023, effectively the realized price was roughly about $4.7 per KSCF or $4.7 per MMBTU, that range. So roughly about $5 per MMBTU. And as you know, in 2023, LNG prices were roughly about 12 to 13, roughly about $13 per MMBTU. That was the average price for LNG.
Okay, thanks, Leonid, also for joining us all the way from UK.
Just the one on Shell, sorry.
Okay, so Khairul Fahmi from Public has asked two questions. The first one is breakdown of the oil and gas for the 7,800 barrels per day production. And you want to answer that first?
Okay, 7,800, we have it here. So our condensate, 7,900 barrels of oil equivalent per day, that is expected production for 2024. And condensate is about 1,200 barrels of barrels per day, and then the gas would be 6,700 barrels of oil. So roughly about 85% of the production is coming from the gas, and then 15% would be from the condensate.
Okay, the second question is, what's the net OPEX per barrel to arrive at the EBITDA level?
So we talked about the OPEX per BOE. In 2023, 2024, it would be roughly about $6 per BOE would be the OPEX number. And then you assume the similar price, for example, $4.7 per MMBTU, 4.7 times 6 would be roughly, let's say, $30 per BOE would be the realized price. And then on top, and so we apply 8% royalty. So 8 times 30 would be 2.4. So roughly about $3 per BOE would be the royalty payments on the gas. So I believe from revenue to EBITDA, it would be these two components, royalty and OPEX number. Yeah, OPEX.
Okay. Sichai from Oakland had asked three questions. I'll do the first one first. Does your pro forma EPS take into account cost of debt?
Is this a direct addition of the earnings that we showed earlier?
The second question is, does the investment meet your IRR criteria of minimum 15% at a $60 to 70 per barrel price assumption? And how much cost savings per barrel is achievable in the near term?
Okay, so as Ken said, it's tough, really tough to get a deal at the lower oil or gas price. But what we are seeing here is at close to $70 per barrel. Okay, the way we think we aim to achieve this more than 15% IRR would be, we believe that there are a lot more opportunities to increase the 2P reserves and 2C resources, which has not been factored into by the RPS Energy. So we believe our internal estimates are better than what RPS has forecasted. And of course, all of those benefits in terms of optimizing the cost for the OPEX and CAPEX has not been has not been taken into consideration in this the fair market value consideration. So we believe that with the current oil and gas price momentum, if it continues for, let's say, even for next 2 to 3 years, and then we would be able to extract more from the reserves and resource perspective, we believe we will be able to achieve more than 15% IRR from this investment as well.
I think, Sichai, this is how we approach all assets. When you are buying from a, let's say, a very established party, a counterparty, you are not going to get a cheap deal upfront. I mean, that just doesn't happen. Nobody just gives it to you because they like you. You have to, you got to look at the asset from their perspective, and you got to price it how they see it. After we are in the asset, we then look at all the value opportunities there are for us. We look at optimization of value, and a year down the road is when we look back on it, we say, okay, this is what we have done to the asset. That's the value we bring to the asset. If not, the asset may as well have stayed with the counterparty in the first place. If we can't bring any additional value, they may as well have operated the asset. So we go in as a more agile organization, and we spend a lot of time chasing the last barrel, sweating a lot of the asset, and just bringing a different cold eye to this asset. Total has been operating this asset for about 25 years. So what we hope to do is just bring a slightly different perspective to some elements of the operations. No doubt they've done a very good job, but their safety record, the production, and all of their achievements there speak to those results. But we hope we will bring a slightly different dimension to the way this asset is operated.
Okay, and the third question is, what was the realized gas selling price for the field in 2023?
It is $4.7 per KSCF, or $4.7 per MMBTU.
Okay, in that slide 9. Okay, then I think we can call upon Jeremy from Hong Leong. You raised your hand earlier.
Hi, I got a few questions. So the first one would be, what would be your projected like capex per year, like development capex per year for this acquisition, for this field?
Okay, we don't have a lot more capex projects here. So we talked about so we have talked about the gas compressor project, which is ongoing, which would be completed by Q3. And apart from it, there are 2 major capex projects which are expected to be executed in 2028, 2029. That would be roughly about close to $40 million net to us. That would help us to upgrade or convert from 2P resources of 6.8 million barrel of oil equivalent to 2P reserves.
Okay, how about like decom capex like per year?
Yeah. So in decom cost, unlike Malaysia, in Malaysia we have to put aside certain amount of cash every year in the decom fund. In Brunei, that's not the requirement. So in Brunei, so we talked about the total decom estimates for this asset. Net to us would be roughly about $70 million. So the $70 million would be incurred, is expected to be incurred in 2040 so we expect to produce up to 2039. And then when we decom the well and then facilities in 2040, 2041, the $70 million will be incurred.
Okay, what is the likelihood that you guys get the 10 years extension?
10-year extension from the 2029. So this is the automatic extension in the sense that if all of the Block V joint venture parties agree to extend the license, then it would be done. So yeah, I mean, if there are the reserves and resources left in the ground, then all of the parties would like to extend the license.
Okay, moving on to your production. So production per day, I think last year was 7.8K per day, BOE, about that.
So last year, gas and condensate combined production net to Total or net to Hibiscus was 6,958 barrels of oil equivalent per day. This year is expected to be 7,865 barrel of oil equivalent per day.
So it's 7.8. Is it fair to assume that there's a natural decline of 5 to 8% per year, all the way till the end of life?
Okay, so here it's slightly different because of gas. In gas, when the gas compressor comes in, we think we would be able to increase the gas production from the same well because we are going to reduce the pressure at the facility. So we think we would be able to produce the gas at this level, about 6,000 to 7,000 barrels of oil equivalent in that range for next few years before it declines because of this gas compressor project, because the benefit from the gas compressor project. Of course, there would be natural decline after a few years. But all of these numbers, Jeremy, would be available to you and to all of us in the circular, because RPS has done the production profile, and all of this production profile and the cash flows will be part of our circular.
Anything else, Jeremy?
Oh, okay. One more. It's what is your targeted OPEX per barrel in this case, or OPEX per BOE in this case?
So for 2022, we have the numbers. So OPEX per BOE in 2023 was $6 per BOE.
But why is it so low compared to like your PM3, which is gas based?
So in PM3, it is gas and oil, yes. And here it's just gas. And here it's...
Can I just help you? Yeah, I think what they have done with this asset is they've made the platforms offshore unmanned, and everything is controlled from an onshore processing plant. So you have a lot less logistics costs. Everything is operated from land, even though it's about 80 kilometers offshore. So they made it, they automated the platform a great deal when they built it.
Okay. Just to add, CAA, the gas processing facility is very complex.
It is a very complex,
high CO2 emission.
Yes.
Here, as we discussed, it's a very low CO2 emission here. So the gas processing facility is very, very simple, right, in terms of the separator and other equipments required. So, yeah.
PM3 CAA is probably, I would say, one of the most complex offshore, shallow water offshore operations in Malaysia, PM3 CAA.
Okay, so in comparison to like your other assets, which range probably about OPEX per barrel of 20 to 30 USD per barrel. So this one, it's safe to assume at about 10 per barrel, 10 per BOE, I mean, yeah, going forward.
Yeah, over the economic life, it is expected to be well below 10 per BOE. That would be correct. But this is not dollar per barrel, it is dollar per BOE. Yeah.
Yep.
Yeah, correct.
Okay, thanks, Jeremy. The questions. Christopher Cock from Kenanga asked 2 questions. The first one is, can you share more details on the offtake agreement? Will all the gas be sold as spot?
Yeah, so gas would be sold to one party, which is BLNG in this case. So we have long-term gas sales contract to BLNG. So yes, the price which we get would be spot price, and it is also a function of the price at which BLNG is selling their gas or the LNG to the end customers. And for offtake also, we have the long-term contract with Total Energy, their trading team. So they would be helping us to sell our condensate. So the price what we get is the spot price, and this condensate is traded at little premium to Brent, $1 to $2 per barrel.
The second question is, the DCF of the asset by RPS is $250 million US. Can you share the kind of assumptions, such as the oil and gas price, the decline rate that they are using?
So we have the oil and gas price, but in terms of the decline, I think we'll just wait for few weeks. So it would be included in the circular. So the production profile every year for each of the scenarios would be included in the circular.
Okay. Fami from Public has asked additionally 6 questions. The first one is to clarify on the Brunei PSC structure, the taxes and royalty. Second one is how much undrawn facilities you have.
Okay,
do that
let's
later.
talk about the fiscal regime first. So it's not, we don't call it PSC. It would be like tax royalty system. So the tax, so the royalty is 8%. So our revenue would be 7,900 barrels of oil equivalent times 365 times the realized price. That would be our revenue. And on this revenue, this royalty of 8% would be paid in cash to the regulatory body. And then apart from it, there are no other payments to the government or to any other bodies, regulatory body in Brunei. And then our tax would be 55%, petroleum income tax of 55%. And we enjoy like normal capital allowance on the capex. All of this OPEX would be part of the deductible expenditures, and also the royalty, what we pay is also would be deductible expenditure. Taxable income computation tax.
Sure. So the second question was, how much undrawn facilities do you have?
I mean, we have enough undrawn
About
facility.
240 million. 240 million US dollars.
Dollars what we have.
Okay. Fourth one is, please guide on the dividend payout with expected incremental EPS to 68 cents.
I think we'll keep the dividend policy the same that it is.
The guidance that we gave earlier.
Yeah, the guidance.
Any conditions or requirements to be met for the 10 years extension?
I think what we understand is as long as all of the three JV partners, in this case it would be Hibiscus and Shell and Brunei Exploration, and their NOC, all three of them, if all of them are in agreement to extend the concession, we will get it for.
Okay. His last question is to guide on the offtake schedule. I'm not sure whether Fahmi, that was already answered earlier. If you have any further questions to that, let us know also. So I think
the gas is sold every month. Now, when we have the gas, we produce and it is sold every day actually, and then the invoicing is done every month at the end of the month. A condensate, yes, there would be like when our share of the condensate in that Scott terminal gets to a particular volume, then only we would be selling it. But it's 1,200 barrels per day times 365 is roughly about 300 to 400,000 barrels. So we would have close to, if the cargo size is 400,000 barrels or 500,000 barrels, it would be one cargo in a year.
okay. And then Kaf Simket asked whether the realized gas price assumption gradually climbs up to $5.8 MSCF by 2039 for the valuation of the field. Do you think that it's reasonable as the Henry Hub price is $2 per MMBTU, or it's not an apple-to-apple comparison due to the different denominator?
Yeah, I would say that the gas price in US is very different from the gas price that we see in UK, North Sea, or the gas price that we see in Malaysia or in Brunei, for example. So the gas price here is linked with the ultimate gas price at which BLNG plant would be selling the LNG to their end customers. So we get part of it. For example, 2023, you would have seen that the Henry Hub price is also almost like $2.5 per MMBTU in that range. But the actual price for Block B asset was $4.7 per KSCF.
Okay. Homing asked, are you still on the lookout for acquiring Malaysian assets, especially the new DROs or PSCs on offer in MBR, the Malaysian bid run?
I think we are just generally on the lookout for the right assets, not necessarily in any one jurisdiction, as long as it's near where we already have some options.
Okay. Tawi from Manulife asked, why is the gas price realized around $4.7 is lower than the market gas price of $12 to 13?
Yeah, that's correct. So the last year, the LNG prices were roughly about $12 to $13 per MMBTU. So we don't get LNG, BLNG doesn't translate the entire the LNG price to us. If they provide it to us, then they would not be able to make any money from the BLNG plant. So what we get is the part of it. So in this case, if the BLNG price is 12 to 13 and we got 4.7, so roughly about 40 to 50% of that one. So it's not fixed; it's a part of it based on the gases agreement. So we don't get the full LNG price for our gas.
Yeah.
Okay. Jared from Maybank Asset Management is asking, can you share the estimated figure on the lockbox when the deal is concluded towards Q4 of calendar year 2024?
I mean, we will not be disclosing this one now, but once the CPR and CVR is out, you would have pretty good understanding on the cash flows that asset generated in 2023 and expected cash flows for 2024. So depending on when exactly we close the transaction, you would get some estimated understanding on the lockbox amount.
Sure. Christina from Muamalat Invest is asking, are there other acquisition targets you are considering, especially in regions with stable regulations?
I think right now, let's just let us just kind of digest this one. There's a lot of work to do, and then we can talk about other opportunities later.
Let's just focus on successful completion.
Yeah, successful completion.
And transition and all that.
Okay, can we unmute Joshua from Mavel? I think he raised his hand earlier.
Hi everyone.
Hi, Joshua.
Hey, hi. Yes, there's just a couple of questions here. So firstly, on the OPEX per barrel, could you walk me through if there is room for cost synergies? And where I'm coming from is that, I think I saw that slide where this field is near Kinabalu and North Sabah. So I'm just wondering, big picture, is there room to share, equipment, vessel runs, etc., across these three PSCs? And if so, how much cost reduction should we be expecting for this asset? That's the first question. I'll do the questions one by one. Maybe you can answer this first.
Okay, I think we will have to respect the I would say the procurement regimes and rules of each country. I don't think we are able to have a frame contract, let's say, across two countries. I don't think that's possible. The Malaysian procurement framework is very specific on who we can use in Malaysia, and obviously the Bruneian structure will also want some local content. So we have to respect those. So I would not immediately see kind of optimization there. I think what we have to do is just to go and look at the asset. There are two sides to the I would say the operational benefits. One is, can we do anything to increase production levels a little bit even, and the 2P reserves, and then obviously look to see how we can optimize the cost side. Right now, what we know is it's an asset that's been run very well, but at the same time, we just need to look at it from using our philosophies and see whether we can improve a little bit.
Okay, got it. And secondly, I was wondering if you could maybe elaborate a bit more about how BLNG is selling their LNG. So are they doing the LNG on long-term contracts, spot contracts? What is it benchmarked against? And where I'm coming from is I'm trying to understand how should I think of the sensitivities for I think the 4.7 MMBTU selling price. Like, what really drives that? What should we pay attention to for that?
My understanding is that they would be doing both. So they would be selling certain LNG at the spot price, and then there would be some long-term contract with companies as well.
Okay. But how volatile has it been historically?
I mean, as you know, LNG price, if you just look at the LNG price, has been quite volatile, right? In 2022, we saw LNG price going to about $30-40 per MMBTU. Last year, it was average about 12 to 13. Now it is currently at about 10. And before that, it was low, So it has, because of the fact that LNG price has been volatile in the last 2 to 3 years. But what we see is that currently it's trading at 10, and most likely our view is that LNG price should be, should be around this level or slightly higher in next few years. That's our view. So,
okay. Thanks. Thanks very much.
Thanks, Joshua. Can we call Chu from Nico Asset? Chu, I know you wrote your...
Hi team. Congrats on the deal. 2 questions from me. As you go into integration, what are the top 2 risks you're trying to mitigate post integration of these assets? And my second question is, when you were doing your due diligence, was there any DD items you were unable to get access to, or Total didn't provide the information you needed that you need to, I guess, follow up post the acquisition?
I think, well, I think there are always risks, but with any transition process. But I think we take comfort from two things. One is we have done transition processes with we have undertaken transition processes in Anasuria, in North Sabah, with the Repsol assets in PM3. We've dealt with different governments. We've dealt with different software systems, all of that. So in the organization, we've got a variety of skills that have allowed us to do these things. The important thing for us is to do it as efficiently and as quickly as possible. I think that's the important thing, because what we want to do is assure the people who are working on that facility that their jobs are not at risk. We want to tell them straight away, as soon as possible, that we are welcoming them all on board. We become part of the Hibiscus team in Brunei. We don't have any other team in Brunei, in fact, and we'd like to keep them all on board. So the important thing is to maintain the expertise, the knowledge and experience associated with this asset. We want to be able to make sure that we retain it and we get even more out of it. So I think that's the most important thing for us. Okay, on the DD side, we cover as much as we can. And it's a very, very thorough process. Just this process has probably taken more than a year. What you see here today is an hour investor presentation and 10 slides. In fact, I was complaining, in fact, to Lily yesterday, saying, how did this whole deal become 10 slides? And we've been working over a year on it and spending a lot of money on it, and it all comes down, it distills down to 10 slides. But there are a lot of legal agreements behind this. There are a lot of assurances, warranties, representations, the salient points of which are all in our announcement. We kind of provide the assurances. So whilst we do as much duty as we can, and we've done a lot of duty over the last one and a half years almost, we also protect ourselves in the legal agreements that we have been given as much information as there is available. So that's how we kind of do it. And we have only had 110% cooperation. That much I must. Total have been extremely cooperative in answering many of our questions.
Okay, sure. I think Jeremy has a question. Can you unmute him from Hong Leong?
I'm not sure whether I heard wrongly, but the tax for this field is 55%, you were saying?
Yeah, that's correct, Jeremy.
Secondly, would be will this acquisition actually dampen your ability to dish out dividends? Or put it this way, decreasing your dividend guidance for next year onwards?
Well, we haven't provided any dividend guidance for financial year 2025 yet, but the intention is to actually have more assets so that we are able to, let's say, buffer any issues in any one single asset. So we're not expecting that we would have a change in our dividend policy, but obviously that is still subject to board deliberations. But there's no plan to reduce dividends.
I shouldn't negatively reduce dividends or negatively impact dividends, because firstly, there are no share issuances here, so it won't increase the quantum of dividends, and it's also a cash flow producing asset.
Okay.
Would you view like this acquisition to be a tad bit expensive?
It depends how you look at it. It meets all our criteria going in. Whenever you are never going to get a cheap deal from a mature counterparty. I mean, if you think somebody out there is that, likes hibiscus and they're going to give us a gift, that doesn't happen. What happens is once you buy the asset on a willing seller, willing buyer type price level, and then you got to go in there and add value and bring all your expertise to bear and all your energy to bear. That's what you got to do, and all your agility to bear also. So, and then a year after or 2 years after, when you look back on it, that's when you say, yes, it was the right thing to do. Or, 2 years down the road, you might be able to say that was expensive or that was cheap or that was the right price. But to try and say today, all it must be is the fair price.
Yeah.
Azim from BIMB is asking, do you expect any negative goodwill recognition upon completion of the transaction?
Well, there are several items that we need to obviously look at, as you know, Azim, between now to completion, including pricing, upon completion. I think that the thing to note is that maybe at this stage, it is not perhaps not yet the right time to really talk about negative goodwill. We'll work on it very, very carefully with the auditors after the announcement. And the focus is really to ensure that the transition is being worked on as perfectly as possible. But we will definitely value this asset very carefully up to the point of completion. But I'm not sure whether it's the right time to really be forecasting the quantum of any negative goodwill at this stage.
Okay, see why. Alvin from Phillip Capital is asking, can I confirm the daily production for gas is 300 to 400,000 per day times 365 days?
Yes, so if you go to the gas production slide, so our gas, so the total production, gas and condensate combined for 2024 is expected to be 7,800. So annual production would be 7,800 times 365. That would be 2.85 million barrel of oil equivalent in a year in 2025. If you just look at the gas, so 6,640 barrel of oil equivalent per day. So if you want to convert to and understand the number in million scf per day, that would be roughly about 38 million scf per day. That would be our gas production net to Hibiscus.
Okay, I think Imran from MIDF, going forward, would you prefer to maintain mixture of oil and gas at the current level, or would you prefer to move more towards gas? Maybe 30%, I think he's assumed 30% oil and 70% gas.
I think we would be quite agnostic to it, oil and gas, but I mean, 50% is a good number to start with at this point of time. Of course, if you have a two option, one with higher, the same deal size, same level of value coming from the deal, of course, we would prefer to go with the more gas. Yeah, more gas. Yeah.
But we can't be selective.
Yeah, we can't be selective.
We can't go and say we want that.
Yes.
Yeah. Okay. And Homing from UOB Asset Management, I saw you have earlier, I'm going to combine both your questions. So you asked, as per February 2024 by Energy Intel, the GSAs with Shell, Vitol, Diamond Gas, JERA, JAPEX are until 2028, not to 2033. We know that. Will you kindly confirm?
I don't know about these numbers, but I think we have seen the agreement, the gas sales agreement up to 2033.
Okay, and are there plans by Petronas to possibly tie Kelindang to boost the LNG production? Is this a key condition for the PSC extension?
Yeah, because this the license extension would be with our discussion with the Brunei government, not with Petronas. Not be
applicable to us, right? Okay, because his follow-up was assuming it was a key plan to boost the Brunei LNG. He believes the key reason was Malaysia and Brunei maritime or territorial dispute. So what makes it different this time that you're interested to buy the asset? He said, assuming Kelindang is a key plan to boost Brunei LNG, but Kelindang proposal was as old as Limbayong. I believe a key reason was Malaysia and Brunei maritime or territorial dispute. What makes it different this time that you're interested to buy the asset?
Not sure. We bought the MLJ asset.
Yeah.
I'm not sure what Kelindang and Bayong and
Is.
all of this. So we bought MLJ.
And we have also not bought the LNG asset.
Yes.
We have not bought the BLNG, right? So we have bought the gas asset. That gas goes to BLNG, right?
Joshua Samuel is asking from all, what is the beta of our gas sales pricing to BLNG to spot LNG prices?
Of our gas sales. So if you just take 2023 as an example, right? So normally the price at which the gas or LNG is sold to the spot or to the long-term contract, especially the long-term contract, that will also be a function of the prevailing LNG at that point of time, and also the JCC price, which is linked with the oil. So effectively, our gas price will also have function of oil and gas, oil price and the LNG price. We just look at 2023 as an example. We saw the oil price about 80 or 82, $83 per barrel. The LNG price was about 12 to 13, and we got 4.7. So roughly 38 to 40% of the LNG price. But this price would not be fixed, because effectively we need to look at the price at which BLNG sells to their customers. And as we also discussed, that when they sell the LNG to their customers, they would be selling at the spot price, which is at spot LNG price, and they would be selling at the long-term contract. And the long-term contract price also takes into consideration of the prevailing LNG price and then the expected oil price going forward as well. I mean, we don't have any number, Joshua, to give you a beta of our gas price and the LNG price here.
Okay, Christopher Cock from Kenanga is asking, just to clarify on the cost of debt, it was mentioned SOFR plus 6%. Is this the bridge financing or the long-term cost of debt? And what will the estimated loan amount be? So
we talked about two things here. So can we go to the purchase consideration side?
Yeah.
So we have $259.4 million of the total purchase consideration. Since the deal is effective as of 1st January 2023, so from the effective date up to the completion, assuming we close the transaction on 14th of October 2024, then the time or the interest which we have to pay to seller would be $17 million. If we close the transaction on, let's say, end of October, so from the 15th of October 2024 up to 30th of October 2024 would be the interest which we have to pay would be the SOFR plus 6%. So I mean, what it says is that, I mean, we are incentivized to close this transaction before 14th October as soon as possible.
As soon as possible.
As soon as possible. Yeah.
Yeah.
Otherwise, we'll have to pay slightly higher interest payment to it.
Azim from BIMB, comparing gas price for Brunei versus PM3 CAA, would it be similar?
So PM3 CAA at 80, it would be close to 5, roughly about 5 plus, right, Andrew? It would be 5.1, 5.2 in that range.
We have seen 2023 opens also.
Almost there, almost very not, very close, but the benchmark to which it is linked are different. So in PM3 CAA, the gas price is linked with HSFO price, which is exactly goes in tandem with the oil price. But here in Block B, the gas price is linked with the actual LNG price at which BLNG plant sells to their customers.
Okay, I think Ho Ming is asking, he said, sorry, he wants to correct his question. My perception is that you will become a supplier of BLNG. Kelindan may become another supplier of BLNG. Whether Kelindan happens or not is not related to you all financially, but related to BLNG. I'm just concerned that you become dependent on BLNG's fate unless you have solid alternative plans to offload or lock in a flexible GSA with Petronas, for example.
We have up to 2033, we don't have any options to sell our gas. And then even beyond 2033, we would not be able to sell our gas to any other party because, you know, the gas requires all of the infrastructure. So we have already infrastructure pipeline linkage with the BLNG because BLNG happens to be the nearest infrastructure to us, right? So we would beyond 2033 as well, we would be selling to BLNG. And whether in terms of pricing, we believe that we have assumed the price mechanism for 2033 onwards would remain the same. That's our assumption in this valuation. And if someone else also sending the gas to the BLNG, if you look at any energy, especially the LNG report, the Total came up with in their investor relation last year in September, October. They said that LNG demand is going to go up significantly in next 5-10 years. So anyone else providing or selling the gas to the BLNG should not have any material impact or any impact on the LNG gas price as such. Because from the consumer perspective, if you look at it, there are many consumers, especially in this part of the world, in India, China, Japan, and at the same time, the LNG is being exported from this part to the Europe as well.
And I think there's one more thing to think about, and that is the importance of this whole infrastructure to the country, actually. So I think, you know, it is a very, very key part of the economy of the country. So I think that gives us a lot of comfort.
Questions? Li Jen from Great Eastern is also asking, she didn't hear the reply earlier, but she wanted to clarify whether the company might go to the market for placement.
No.
Equity issuances required.
I made it very clear.
Yes. Any other questions? Xiang from Z Capital has a small question. It's asking whether the BOE pricing, is it tied to Brent like Malaysia?
Yes.
The pricing, is it tied to Brent?
So it's not tied to the Brent, but in a way it's tied to like LNG and Brent both. Because what we have seen is the price at which BLNG sells to their customers is also a function of the prevailing LNG price. And if it is a long-term contract, then it also the price is also a function of the Brent price forecast as well. So our understanding is that if the oil price goes up, the price will go up.
And he's just saying production is about 7,000 for 2023, meaning plus minus about 2.8 to 3 million barrels. That makes sense. 1 BOE is about 6 MSCF, right? That means it's about $28 per BOE. So it's calculating.
$28 per barrel. Yeah, that's correct. That's correct.
Yeah. So he said if it's 3 million times $28 per BOE equals about $80 million.
Yeah, that will be revenue.
Revenue.
Yeah.
Okay. Then he was wondering how come the revenue is $150 million in 2023.
So in 2023, 150 was the PAT number, and that was in ringgit, right? So if you do the maths, you will see that the 2024, based on 7,900 barrels of oil equivalent, look at the condensate volume, multiply with 365, assuming $80 per barrel about that selling price for condensate. And if you assume $4.7 per KSCF for the gas, you will see that the revenue would be close to $110 million.
Okay. Any other questions? Now we'll end the call today. Thank you everyone for joining our briefing today. The webcast recording for this briefing will be uploaded on our website by next week. Once again, thank you so much. Please feel free to reach out to us if you have any questions. Thank you. Take care and stay safe.